So you know how you mentioned those changes to how mutual funds are taxed?
Yeah.
Well, we're going to really dig into that today. We're using this HDFC mutual fund document called Weekend Bites from September 2024.
Okay.
It analyzes the 2024 union budget and how it affects all this stuff.
Right.
So yeah, we're going to break down what that means for you.
Yeah, that's good.
Yeah. Specifically those changes that went into effect like around July 23, 2024.
Right. So financial year 2024-25.
Right.
Assessment year 2025-26.
Okay.
Which is what their report highlighted.
Okay.
And according to HDFCMF, the whole point was to try to make the tax rules a little simpler,
Got it.
which, they tried to do, but it's always complicated.
Yeah, it's always, well, anytime taxes are involved, it always seems to get a little bit,
Yes.
Yeah.
A little bit messy sometimes.
Yeah. So anyway, HDFC's analysis covers commodity ETFs, commodity funds of funds,
Right.
other funds of funds that have less than 65% in debt, then like obviously equity mutual funds and debt mutual funds.
Right. The usual suspects when it comes to mutual funds.
Yeah, exactly. So like I said, we're going to walk you through each one of those.
Okay.
And we're going to use, HDMF's explanation of the key tax changes.
Yeah.
And then try to explain what that means for like your investments.
That's the most important part, how this actually affects you.
Yeah, exactly. So why don't we start with those funds that are linked to commodities?
Okay, sounds good.
And the other funds of funds that, have a lower debt exposure.
Right, right. So when we're talking about commodity ETFs, commodity funds of funds, and those other funds of funds with less than 65% in debt, how they are taxed now really depends on when you first bought into those funds.
Okay.
So if you purchased units before or on or after April 1st, 2023, that's the dividing line here.
Oh, okay.
So it's almost like, when they change rules in a game,
Right,
and you're already playing, it's like, wait a minute, the rules are different now?
Right.
So first, let's look at those units purchased before April 1st, 2023.
Right.
So then, meaning if you sold them before March 31st, 2025, any long-term profits, those were taxed at 20%.
Okay.
And you got the benefit of something called indexation.
Oh, right.
And I know that term can be a little confusing. But what indexation does is it adjusts the original price you paid for your investment to account for inflation over time.
Right. Makes sense.
So this basically reduces the profit that's actually being taxed, which is a nice benefit.
So it's not if inflation's like 8%, it's not like you're really making 8%.
Exactly. It's really trying to tax your real gains, not just the gains due to inflation.
Right.
Now, in this then scenario, to be considered long-term, you had to hold on to these investments for more than 3 years.
Okay.
Anything less than that, it was considered a short-term gain, and that would be taxed according to your income tax bracket.
Okay, so if you sold it within 3 years,
Exactly.
it would be considered short-term.
Right. Right. So that was then. But now, things are a bit different. So now if you sell those same units that were purchased before April 1st, 2023, but you sell them from April 1st, 2025 onward, things have changed a bit. The long-term capital gains tax rate goes down to 12.5%.
Oh, okay.
Which, on the surface, sounds great.
Yeah, that sounds better.
But here's the catch.
Yeah.
You no longer get that indexation benefit.
Oh, okay.
And the time you have to hold them to be considered long-term has also been shortened. It's only 1 year now for commodity ETFs and 2 years for those other funds of funds.
Oh, wow.
And as before, any short-term gain, you're still paying your regular income tax rate on that. So it's like, okay, lower rate, but you're giving up that protection against inflation.
Right. So even if it goes up, it's not really, it could just be you're paying tax on.
Exactly. You're paying tax on the inflation, basically.
Right.
Even though your real purchasing power may not have gone up that much.
Got it.
So that's something to consider there. Now, here's what's interesting. For units that were purchased on or after April 1st, 2023, if you were to sell them before March 31st, 2025, so this is the then scenario.
Okay.
Both long-term and short-term capital gains were basically treated the same.
Oh, interesting.
So any profits, they just added those to your income, and you got taxed at your regular rate.
Okay.
There wasn't really a long-term holding period for these newer investments.
Got it.
But now, from April 1st, 2025 onward, even for these newer units, there's a long-term capital gains rate of 12.5%.
Okay.
That kicks in. And again, short-term gains, just like with the older units, still get taxed at your regular income tax rate.
Okay.
And the holding period to be long-term. 1 year for commodity ETFs and 2 years for the other funds of funds.
Okay. So essentially, They've made it so that anything bought before April 1st, 2023.
Right.
If it was sold, let's say, last year, that was
Different rules.
Different rules.
Than this year, coming up.
Coming up, yeah.
Exactly. So you really got to look at those dates.
Got it.
So connecting all this together,
Yep.
HDFC-MF is saying that these categories, commodity ETFs, commodity funds of funds, the other funds of funds, with less than 65% in debt, they now potentially have a more favorable tax structure.
Okay.
For those who are redeeming their units, like selling them, from April 1st, 2025 onwards.
Right.
That's when this new long-term capital gains rate and the shorter holding period really make a difference.
Right. And the fact that they've introduced a long-term capital gains
Exactly.
at all.
For those newer investments.
Yeah.
It's a big shift.
Got it.
Now, they give a really good example.
Okay.
They talk about gold and silver ETFs. They say now, with just a one-year holding period,
Okay.
investing in those might actually be better tax-wise
Okay.
than just holding physical gold.
Right.
And then, of course, you got all the other benefits of ETFs.
Yeah.
Convenience, safety, purity, liquidity. Often they have lower costs.
Right. Yeah.
So it really makes you think twice if you're just sitting on physical gold as an investment.
Yeah, definitely. That's a good point. It makes a lot of sense. So let's move on to equity mutual funds.
Okay.
Because those have always been taxed a little bit differently.
They have, and there's been some changes there too, specifically from July 23, 2024.
Okay. So then before that date, July 23, 2024,
Right.
if you made a long-term profit on your equity mutual funds, and remember, long-term means holding them for more than a year,
Right.
the tax rate was 10%.
Okay.
But you got to exempt the first 1 lakh rupees
Right. There was that exemption.
of gains in that financial year.
Right.
So for profits made within a year, so short-term gains, the tax rate was either 15% or 20% according to their tax reckoner.
Okay. So a little higher for those short-term gains, as you expect.
Yeah, and just like those commodities we were talking about, the holding period to qualify as long-term is still 1 year.
1 year. That stayed consistent. Okay, so what about now?
Okay, now, for any profits you make on or after July 23, 2024, when you sell your equity mutual funds, the long-term capital gains tax rate has gone up a little to 12.5%.
Oh, so a slight increase there.
Yeah, but the exemption limit has also gone up. Now it's 1.25 lakh rupees.
Oh, okay, so that helps offset the increase a little bit.
Yeah, and the short-term capital gains rate, at least according to the reckoner, is still 15%.
15%, okay.
So even though that long-term profit tax rate went up a bit, a lot of people might actually benefit from that bigger tax-free amount, right?
It could work out better for some investors, yeah.
And the 1 year holding period hasn't changed.
That's good. At least that's consistent.
Right.
And HDFC-MF actually specifically points out that equity mutual funds still look pretty good from a tax perspective.
Yeah, they do.
All things considered. Okay, so let's move on to debt mutual funds.
Right.
Now, this is where things get a little messy
Okay.
because it depends both on when you bought them and when you're selling them.
Okay, got it.
So first, let's look at those debt funds that were purchased before April 1st, 2023. So back then, if you sold those before July 22, 2024,
Okay.
long-term capital gains were taxed at 20%.
Okay.
And you got the benefit of indexation, which, like we talked about before,
Right.
helps adjust for inflation. But you had to hold these for more than 3 years to be considered long-term.
Got it. So 3 years or more to get the...
Long-term benefit.
Yeah.
And if you sold before that, those gains were considered short-term, and they got taxed at your regular income tax rate.
Right. Okay.
Now, if you sell those same funds,
Okay.
the ones purchased before April 1st, 2023,
Mm-hmm.
but you sell them from July 23, 2024 onwards, the long-term capital gains tax rate has gone down to 12.5%,
Okay.
which again sounds good at first,
Yeah.
but, and this is a big but, you no longer get indexation.
Oh, okay.
No more adjusting for inflation. So even though the rate's lower,
Right.
you might end up paying more in taxes.
Because of the inflation. Yeah, that makes sense.
And they did shorten the holding period to qualify for long-term gains.
Mm-hmm.
It went from 3 years down to 2. And again, short-term gains, you're still paying your regular income tax rate on those.
Okay. So it's like you get kind of a mixed bag.
Right.
Like lower rate, shorter holding period, but no indexation.
Exactly. So it's not a clear win. You really got to crunch those numbers.
Yeah.
All right. Now, what about debt funds purchased on or after April 1st, 2023?
Okay. So then if they were sold before July 22, 2024, what were the rules?
Okay. So for those newer ones, there wasn't really a difference between long-term and short-term capital gains.
Oh, interesting.
As far as taxes go, any profit you made,
Right.
no matter how long you held it, was just considered short-term gain,
Okay.
and it got taxed at your regular income tax rate.
Mm,
There wasn't a special long-term rate or a holding period for those.
got it.
Now, if you sell those same debt funds purchased on or after April 1st, 2023, from July 23, 2024 onwards,
Yeah.
has anything changed?
Right.
It's basically the same.
Okay.
There's still no long-term capital gains category for these,
Yep.
no specific holding period.
Got it.
All profits are still considered short-term gains,
Right.
taxed at your regular rate.
So the big change is if you invested in debt funds before April 1st, 2023,
Exactly.
especially the loss of indexation
Yeah, that's a big one.
for long-term gains.
And HDFC MF even points out that even though debt funds still have advantages like professional management, diversification,
Yeah.
that loss of the inflation adjustment is likely to lead to a higher tax bill
Right.
on those older investments when you eventually sell them.
Right. Especially if you've been holding them for a long time.
It really highlights how these rule changes can affect you differently depending on when you made your investments.
Yeah.
So what does HDFC MF say about the overall purpose of all these new tax rules?
Well, they basically agree with what the government said,
Okay.
that it's about simplifying the tax structure.
Okay, so trying to streamline things.
Right. And by moving towards having those more consistent long-term capital gains tax rates across different types of investments, it's like they're trying to make it, easier to understand, supposedly.
Right, a more uniform system in
Yeah,
theory.
in theory, yeah.
Yeah.
And what do they suggest for investors who are trying to figure this all out?
They basically say you need to take another look at your investment strategies.
Right.
With all these new rules in mind.
Right, because it's all changed.
And they really emphasize talking to a financial advisor
Right.
who can give you advice for your specific situation.
Yeah,
Because it's not one size fits all.
No, not at all.
Right.
All right, so as we mentioned, the HDFC MF document has this tax reckoner, which breaks down some of the key capital gains tax rates. So maybe we could just go through that quickly.
Yeah, let's take a look.
All right.
So let's start with long-term capital gains. For investments other than equity-oriented schemes,
Okay.
so things like debt funds and commodity funds we talked about, if you sold those before July 23, 2024, the LTCG rate for resident individuals, HUS, domestic companies, and non-resident individuals was 20% with indexation if the units were listed,
Okay.
and 10% without indexation if they were unlisted.
Okay, so listed, meaning they're on
On a stock exchange, yeah. Easier to buy and sell.
Right, okay. And then what if you sold those same investments, the other than equity-oriented ones,
Right.
on or after July 23, 2024?
So now the rate is 12.5% without indexation for everyone.
Oh, okay.
And the holding period to be considered long-term has changed too.
Oh, how so?
It's more than 12 months for listed units and more than 24 months for unlisted ones.
Okay, so longer if it's not listed.
Exactly, because they're considered less liquid.
Got it. So what about equity-oriented schemes? What are the long-term capital gains rates there?
Okay, so if you held the units for over a year and you sold them before July 23, 2024, the rate for everyone was 10%.
Okay.
After July 23, 2024, it's gone up a bit to 12.5%. But remember, that's after you factor in the 1.25 lakh exemption.
Right, right. And this is only if STT has been paid, right?
Absolutely. Securities transaction tax. You have to have paid that when you bought and sold in the case of equity shares, and just on the sale for units of an equity-oriented mutual fund or business trust for those lower rates to apply.
Okay, so a little more complex there. All right, let's move on to short-term capital gains rates in this tax reckoner.
Sounds good.
What about those other than equity-oriented schemes? What's the deal there?
So for those, the rates for individuals, companies, everyone are just taxed according to your income tax slab rates.
Okay.
That's the same before and after July 23, 2024. But there's this thing called specified mutual fund schemes, and that's important.
Ah, yes, the specified mutual fund schemes. What are those exactly, and how are they taxed?
So basically, it's a fund that invests no more than 35% of its total assets in equity shares of Indian companies.
Okay.
And that's calculated annually based on daily closing values. Now, here's the thing. If you bought units in one of these specified mutual fund schemes on or after April 1st, 2023, any gains you make, no matter how long you hold them, are treated as short-term.
Oh, okay.
And they're taxed at your regular income tax rate.
So even if you hold it for 5 years, 10 years,
Doesn't matter. Short-term gains.
wow, that's a pretty big difference for those investing in debt-heavy funds.
Yeah, it is. And they're actually proposing to change the definition of a specified mutual fund from financial year 2025-26 onwards.
Really?
Yeah, it will include mutual funds investing more than 65% in debt and money market instruments, or funds that invest 65% or more of their total assets in units of those debt-oriented funds.
So it sounds like they're expanding what counts as a specified mutual fund.
Exactly. That means those short-term tax rules could apply to even more funds in the future.
Okay, good to know. So to finish up this tax reckoner section,
Right.
what are the short-term capital gains rates for equity-oriented schemes?
Okay, so for those, if you hold the units for a year or less and then sell them, the rate is 15% for everyone,
Okay.
whether you sold them before or after July 23, 2024. So that hasn't changed.
Okay, so the short-term gains tax on pure equity funds is pretty stable.
Pretty much, yeah.
So the HDFC document also has some important notes, not just those tax rate tables. Like, what else did they want to highlight?
So one big one is they go back to the long-term capital gains tax on equity shares, equity-oriented funds, and units of business trusts.
Okay.
Like we said, it's 10% before July 23, 2024,
Right.
and 12.5% after, with that increased exemption of 1.25 lakh.
Right.
But they really emphasize that lower rate only applies if STT has been paid.
Right.
They also remind us about the grandfathering rule for long-term capital gains on equity investments made before January 31st, 2018.
Oh, right.
Any gains up to that date are kind of protected from this new tax regime.
Right, so if you bought those before, then you're good.
You're good, yeah.
Okay, what else?
They also bring up those deemed short-term capital gains again.
Oh, right, for those specified mutual fund schemes.
Exactly. Those bought after April 1st, 2023.
Right.
And they're stressing that it doesn't matter how long you hold them.
Right.
They're always going to be treated as short-term and taxed at your regular income tax rate.
Okay.
They also point out that STT is going to be deducted when you sell switch
Right.
or redeem units in equity-oriented schemes.
Okay, good to know. What about non-resident investors? Any notes for them?
Yeah, so they say that for non-residents, tax on both short-term and long-term gains will be deducted when they redeem their units.
Okay.
It'll either be 20% plus any extra charges or the rate specified in the tax treaty between India and their home country, whichever is lower.
Right, so it depends on their specific situation.
Exactly.
All right, and last but not least, the disclaimer. What's the main point they're making there?
They're just saying, hey, this is just general information.
Right.
Tax laws can change,
Yeah.
so don't take this as professional advice.
Right, always good to check with a...
Talk to your tax advisor, they say, to figure out how all this applies to you.
Yeah.
Don't make any big decisions based on just this.
Right, well said.
So yeah. To sum up, we've gone through all these recent changes in how mutual funds are taxed.
Right.
Using this HDFC analysis.
Right. We covered commodity ETFs, funds of funds, equity mutual funds, debt mutual funds.
Right.
Looking at those important dates, April 1st, 2023 and July 23, 2024.
Key dates for sure.
Yeah. And those key changes in long-term and short-term capital gains tax rates,
Right.
the rules for specified mutual funds schemes, and all those additional notes about equity investments, STT, and non-resident investors.
There's a lot to keep track of, but the big picture is it seems like they're moving toward having more standard long-term capital gains tax rates across the board.
Right.
But that removal of indexation for some debt fund holdings,
Right.
that's a big one to watch out for.
Yeah, definitely. So hopefully after this, you're feeling a bit more clear on how these changes work and how they might affect your own investments.
Yeah, it's definitely a lot to digest.
Yeah.
But understanding it can help you make smarter decisions going forward.
Exactly. So here's something to think about. Given all these new rules around mutual fund taxation,
Right.
do you need to change your investment mix?
That's the big question.
Yeah, or how long you're planning to hold on to your investment.
Their time frames. Yeah,
Yeah, definitely something to ponder.
absolutely.
Well, thanks for joining us for another deep dive.
Thanks for having me.
Yeah.
It's been great.
Always a pleasure.
It's been fun.
All right. Until next time.
Take care.